Hello, everyone. Today on the final bar, we will celebrate the S&Ps once again, making a new all-time high, closing just above 4550, really accelerating to the upside in the last hour and right into the close. Got the alert on the dashboard just before 3:30. S&P sets a new all-time high. So what are the conditions underlying this renewed strength in stocks on a day like today? Consumer names doing just fine. Energy actually struggling. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using the technical toolkit to better quantify investor decision-making, investor psychology, investor sentiment. And if you're trying to measure investor sentiment on a day like today, it's hard to argue that it's anything but fairly constructive, right? I've been told a number of things over my career and reminded about things like the most bullish thing the market can do is go up, which is what Paul Montgomery said, the author of Universal Economics for over 5 decades. Who else? Richard Russell said the worst thing an analyst can do is remain bearish in the face of a rising market. He authored the Dow Theory Letters for over 5 decades. So, it is a tried and true, reality of Wall Street that the worst thing to do is to remain negative when the evidence continues to point higher. And I think on a day like today, you're seeing the S&P establish once again its ability to make new highs in spite of all the evidence we could come up with 5 reasons why the market should go down from here. We could do it, but at the end of the day, what is the market actually doing? Now, what's interesting is yesterday had kind of a defensive tilt to things. Today, a little bit more on offense. I'm excited to talk to Craig Johnson from Piper Sandler here in a little bit, get his take on these leadership rotation themes and what is actually propelling stocks to new highs. We're going to get to Craig and a little bit later in today's show. We have great guests coming up for you next week on the final bar. On Tuesday, the 26th, we have Roman Bogomasov from Wyckoff Analytics in San Francisco. On Wednesday, the 27th, Pat Serezna. Pat's the co-host of the Market Huddle podcast. Next Thursday, the 28th, we have Doug Bush. Doug's the founder of Chart Smarter in New York, one of my favorite pure stock pickers, to be honest with you. Also next week on the 27th, that's Wednesday, we have our latest episode of The Pitch. My friend Grayson Rose is going to be hosting a really fun conversation with 3 guest experts. Greg Schnell, Mark Newton, and Jay Woods are going to share with you their latest ideas. Go to stockcharts.com/thepitch for more info on that event. Also, all the previous episodes that we've done on Stock Charts TV. Let's continue on with today's market recap. So as I mentioned, I think the real number one story here is the S&P's acceleration to the upside. And we've talked at times about that last 30 minutes. Recently you've seen some weakness in the last 30 minutes, and that tends to illustrate, sort of institutional distribution. That tells you that there's more sellers than buyers, or maybe better put, more selling pressure than buying power, I guess is how we might be better to describe. But today, sort of a complete change, right? The S&P just deciding, or investors are deciding, today's the day the S&P gets above those September highs. So the question now, I think, as we look at a chart of the S&P 500 here, is whether this breakout, if you call it that yet, has staying power. Now, let's be absolutely clear. We are at the previous highs. I think you could clarify today's upwards move as 6 weeks after the previous reaching of 4550. We have now retested those levels. What happens tomorrow and into next week is crucial, because that will tell you whether we validate that breakout or whether we have follow through to confirm the upside power, right? So the upside momentum on stocks. There's been a lot of momentum in the market in the last couple of weeks to make October overall a fairly constructive month and to propel stocks really to where they're at now. The question is there enough buying power there left in the tank to push us onward and ever upward? And whether we can confirm, whether we can get above 4550, now I think that's what you want to look for. And if we do break out, it's just like with a lot of the charts that we'll talk about CSX, one of the railroads, a little later today, just recently breaking to new highs. The question is, does it hold those breakout levels? The chart of Netflix, another good example of that. Do we maintain above those previous levels that we broke? We'll come back to charts like IBM that are sort of on the other side. They're breaking the wrong way at the moment, but Netflix is a chart we've talked about quite a bit recently. And if you take this resistance level, sort of this, the July high from last year, the January really high from earlier this year, you can see we broke above those levels in early September. We retested the breakout level from above, and now we're rotating higher. A nice follow-through day today, by the way, with Netflix up 4.5%, finally sort of reacting to some of the news or the earnings earlier this week, really continuing to push higher today, which is nice, impressive follow-through day so far. But my question is, does it remain above that breakout level, sort of that 580 to 600 level? That was the resistance here from July of last year and January of this year. Also the support from September. Do we maintain that on any sort of pullback? Do we maintain the 50-day moving average now nearing 590? So on a breakout, the question is, do we get the follow through? Arguably on the chart of Netflix, we're getting that. When I look at the chart of the S&P, that's what I'm looking for, is that breakout. We don't just reach the level, but we get above there and follow it to the upside. The momentum characteristics, though, overall very strong, and I feel like I'm jumping around all over the place. So apologies for that, but sort of the nature where the market is right now. It's funny, last time I updated this chart, which was last Friday, I had a lot of these in neutral color. I don't know if I'll necessarily change them bright green to indicate broad bullishness, but overall we're getting closer, right? I think these are the cumulative advanced decline lines for the New York Stock Exchange, for the S&P, for the mid-cap index, for the small cap index. So large, mid, and small, and if you look at them, all of them are nearing the previous highs, right? This is where the advanced decline lines were the last time we made a new all-time high in early September. From there, the AD lines all came down. All four of them broke below their 50-day moving average. Now all four have regained their 50-day. So I'm totally comfortable making them sort of a neutral orangish, amberish color, because that indicates that we're sort of in that sideways direction. If and when they eclipse those early September highs, I will probably most likely turn these green, which would indicate a bullish advance. So, the question is, how do we validate it? How do we confirm the S&P making new highs? These lines all making new highs above their September swing high would confirm that, in my opinion, for sure, particularly small caps, which is where you've not necessarily seen the leadership that we've seen before. Coincidentally, I recorded a video on my YouTube channel just in the last week on these three breadth indicators. Actually, I think it was yesterday, looking at these three particular indicators we'll talk about here. So if you want more color than we can get to in the show, go to my YouTube channel called Market Misbehavior, and you can see the latest video. Kind of talks in a little more detail about what the implications are of these three breadth indicators. But the two other things I'll be looking for here are an expansion to new highs, which I think we're starting to see here in October, particularly the New York Stock Exchange. We're seeing more and more stocks making a new 52-week high, really before the S&P was today. And also the percent of stocks above their 50-day moving average. Right now, it's about 64%. If you look a couple weeks ago, in the end of September, it was at 24%. So literally in the last couple weeks, 40% of the S&P members have gone from being below their 50-day moving average to above their 50-day. So just like the S&P has regained its 50-day, 40% of the S&P have done the exact same. That's over 200 S&P stocks. S&P members out of 500 have gotten back above their 50-day moving average. That overall is pretty constructive. If we would pull back from here, does that remain above 50%? That would be the question I would be wanting to answer to determine whether or not this market is continuing to show signs of broad strength and not just a narrow set of leadership. What else can we talk through today? The New York Stock Exchange composite actually was net negative, as was the Dow Industrial Average. The mid cap and small cap indexes all in the positive. The NASDAQ 100, one of the best indexes, up almost 0.7%. And the VIX has dipped below 15. We're going to talk about some of the sentiment indicators a little later in today's show. We'll look at a chart of the VIX, and Katie Stockton, my guest on Tuesday, actually pointed out the VIX, and we'll revisit some of her comments and how they've played out so far. Interest rates continue to push higher. So interesting to see the 10-year yield actually increasing. Financials actually were down today, about 0.4%. A lot of banks obviously reported last week. Some of the regional banks this week. We had Zion on Monday. What else? A couple of the others. Oh, BK was on Tuesday. DFS Wednesday. That's Discover Financial Services. So maybe worth looking at some of those themes and how they relate to financials being down, but overall interest rates higher. I would argue, I think you certainly need to be familiarizing yourself with what happens and what's most likely to happen in a rising rate environment. As I was mentioning in an interview last week, One thing that I have never experienced is an extended rising rate environment. I started investing in the year 2000 for the most part. And from then to where we're at today, for the most part, my experience as an investor has been with rates going lower and lower. Unless you've been investing before 1980, you really haven't seen what happens when bond prices are going down over a consistent period and when rates are going higher. I would be revisiting what those periods might have looked like, what stocks tended to lead, what stocks struggled, and make sure you think about that in that sort of rising rate playbook, because it may be time to dust that out in the coming years. I would argue that's very much the case. Commodities as a whole down in a pretty big way, gold and silver especially down, but also oil prices and others. Energy, as I mentioned, the worst S&P sector, down almost 2% today. Cryptocurrency is all very much in the red. Now, before we get too negative on cryptos, Bitcoin yesterday hit 67,000. Now it's down to below 63,000. Again, I've mentioned many times, if you enjoy volatility and uncertainty, you have a lot of excitement to be had in cryptocurrencies. Interesting point earlier this week, the latest Bitcoin future ETF actually was released, and that certainly providing some additional focus on cryptocurrencies and on Bitcoin in particular. But so far today, giving back some of the gains we gave. Yesterday was an exponential rise to 67,000. There's a lot we can give back and still overall be in a pretty constructive tape for Bitcoin. Remaining above 60,000, I would argue, is now the latest thing to look for now that we've broken back below the all-time highs from earlier in this year. In terms of sectors, we talked about it, the big story, positive consumer discretionary, weak energy. Everything else is sort of right around the zero line. So let's think about some of those leadership themes as we continue the show and see what sort of themes we can tease out. We need to take a quick break. We'll be back with today's guest, Craig Johnson. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the markets using the power of technical analysis, investor psychology, sentiment, trying to make sense of these markets by using the power of charting. A couple quick comments before we get to today's guest, Craig Johnson. First off, we love to hear from you, particularly questions that are coming up as you are analyzing your own charts. You can send us an email with any of your questions, thefinalbar@stockcharts.com. We're also on Twitter @FinalBarSCTV. We're on YouTube. Go to our videos there on the Stock Charts channel. Put a comment below the video you're watching. We'll gather all those questions. Hope to answer one of your questions on our next mailbag segment, which will be on Friday's show this week. Also, as a reminder, go to StockChartsTV.com. That is our free on-demand platform. You can see all of our content, great guests like Craig Johnson and many others, special events like The Pitch and our year in review coming up in December, and all the great programming we have every trading day of the year. Go to StockChartsTV.com or on any of your mobile devices, search on the app stores for StockCharts TV on demand. I want to welcome on today's guest, Craig Johnson. Craig's the technical analyst at Piper Sandler, based in Minneapolis. He's been on the show many times before, always brings a great deal of expertise and experience along with him. Craig, welcome to the show today.
Dave, thanks for having me on. I appreciate it.
Good to see you. And when we're talking about the market environment, we have the S&P, really accelerating into the close today, making new all-time highs once again. We're looking at the S&P here on the screen with some breadth indications. What are you? How are you seeing this market? What's your takeaway from this week so far?
Yeah, Dave, what I'm thinking about with this market is we've had this correction, and then we have this 6-day rebound very, very quickly, getting us back now to all-time new highs. Only one conclusion you can come to as a technician is that this sort of corrective phase that we were going through in September is now over, and we're now breaking out the new highs, and this was just a pause that refreshes. And when you go through and you start looking at the number of stocks above their 50-day moving averages and those kind of indicators, you can clearly see that the breadth of the market is starting to improve and starting to turn more positive. And Dave, our thought has always been that we'd get to about 46.25 by year end. We're 1 to 2% away from that particular level at this point in time, and we still think that we're going to get there. And then, Dave, if I could just add, the lifeblood of any sort of market is going to be rotation. And you've definitely seen this sort of rotation in the market. And when we go through all the work that we got here at Piper Sandler, terms of our database and all the industry groups we look at, it's really right now financials and energy that's really starting to lead the way. And I think all of the guests need to take a hard look at energy. A lot of people aren't wanting to look at it, but there's a lot of stocks like Halliburton that are making big inverted head and shoulders bottoms, and Range Resources and stocks like that that are really starting to look quite constructive, but nobody wants to look at it.
It's so true. I feel like we tend to have blinders on certain areas of the market, right? Where we're either into it or we're not. And it's interesting, this sort of environment. Things like energy and financials have done very, very well. I would argue, I would argue a lot of people aren't there yet. Chart of Halliburton is what we have up here now. You mentioned sort of this rotation and where you're seeing some strength. Break down the chart of HAL from your perspective.
Yeah, so breaking this particular chart down, you can see that you've got a left shoulder, you've got a head, you've got a right shoulder. And this is one of the classic sort of technical setups, which suggests that a bottom has been made in a stock. And then what you can do, Dave, is you take that head at the very bottom of the chart up to the neckline, you measure that and count that out. And once you do that count and measure it out and stand it up at the breakout point, it gives you an indication of where this could ultimately move to. And by just sort of, quickly going through and looking at those numbers, I don't know why this couldn't be a mid $40 stock. And you look at it today here in the mid 20s and say, it's got a lot more upside and a good risk reward at these levels.
It's so and it's true. I was told, as I'm sure you probably would echo, never confuse the top of the page with resistance. And just because some of these things have had a run doesn't mean they can't go further. If I could ask you, we have a minute left, Craig, but when you're looking at charts like Facebook or something, I know some people have thought about names like this that had been leadership, that have been doing very well, on a relative basis, did pretty well for much of 2021. All that changed in early September, now pulling back to its 200-day. Do you see opportunities in some of the growther areas of the market? Or does it feel like between now and year end beyond, it's really you're better off looking at the cyclicals? How would you think about a name like FB here?
Well, when I look at something like Facebook, the relative has been a little bit weaker, but we've corrected right back to support. There was a well-known technician, Dave, that that would often say, stocks are innocent until proven guilty. And when you look at a chart like Facebook in here, you can see that you've just corrected back to an upward trending 200-day moving average. And this is a stock that you would say, yeah, well, it's underperformed here a little bit. The relative is improving. You got to be on board. This is also very similar to what you see happening with Netflix too, Dave. Same kind of setup. But with Netflix, looks a little more constructive among these big large cap names because the relative performance has started to pick up and they've got no inventory problems. So when you're thinking about holiday gifts, think about me and Netflix, Dave.
I love the take, Craig. I won't share with everyone some of the gentleman bets we have had on the markets, but I do remember for a fact, anytime you have been bullish and I've been bearish, you've pretty much 100% of the time won on those. So I will not fight you on this one. I certainly see the evidence that you're citing there. Craig, listen, thanks so much for joining us. Be well, stay safe. We'll talk to you again soon.
Thank you, Dave. Have a great day. And thanks, everyone.
That's Craig Johnson. Craig's the technical analyst at Piper Sandler in Minneapolis. And I love that sort of overall view on charts like Halliburton. And if you caught the beginning when we were introducing that chart, sort of said, no one really wants to think about energy. And I think that is one of the beauties of charting. The charts don't care what you think is important or not, doesn't care what ideas you think should work. It's showing you what's actually playing out. It's undeniable that some of these names have had pretty good rises, things like HAL and others sort of hitting resistance and starting to break through there. So the question is, do we achieve some of those upside targets? That certainly could be some of the momentum that could get the S&P much higher than it's been through today. Great take there from Craig Johnson. Let's continue on with our next segment on sentiment called It's Getting Sentimental. Let's focus on some of the sentiment indicators. A lot of these update Wednesday into Thursday, and so it's often a good idea to pay attention to them. And again, for me, it's priority-wise, price, then breadth, then sentiment. When I'm thinking about how to make sense of the macro environment, it always starts with price. And Rafat Kampora, who is a mentor to both Craig and I early in our careers and continues probably to this day, he reminded me, if you had one thing to make sense of the S&P, make it a chart of the S&P. That's the starting point. Everything else helps you qualify it, maybe understand it a little more effectively. The second thing for me is breadth, trying to make sense of all the individual names that comprise those indexes. Can you get any major themes or patterns from the stocks that are participating or not participating in the current macro trend. Finally, you have sentiment. And for me, it's a very important third part of that process, the third pillar to the stool, if you will, which helps you understand what investors are thinking as communicated by survey data, as communicated by their positioning in the equity markets and the options market. And we're going to look at some of those indicators here in a moment. So we're going to start with the VIX. We look at a couple different things. One, we'll look at volatility. We'll look at some options data. We'll look at survey data and positioning data to try to understand what investors are seeing, what they're saying, and what they're thinking, and how they're expressing that in their portfolios. The VIX is certainly at the lowest level that it's been so far in 2021. What's interesting is if you take where the VIX is now versus some historical years, we're not that low. And I would remind you, just like we saw with the chart of Halliburton breaking out, don't confuse the top of the page with resistance. On the other side of that, don't confuse the bottom of this page with support. Just because the VIX has gone down a lot does not mean the VIX can't go much lower. We have seen the VIX much lower than 15 to the low teens, even below 10 at times. And not too long ago, a couple of years ago, we consistently had a relatively low volatility environment for an extended period of time. Just like we saw when the market sold off, you saw the VIX spike in early 2020 and go well above 40, 50, 60 plus as volatility increased. You had a high volatility regime. So be careful not to think just because the VIX is at its lowest point that it can't go lower than that. However, what's interesting right now is that we are really at the lower level we've been for the last 6 months. A number of times the VIX has gone down below 16, 17. The most recent times we've seen that are in early July, in early to mid-August, and now what we're seeing right now. In those last couple times, it has indeed been a pullback of sorts. And again, it's been a couple days at most. It's been brief pullbacks to a week or two, and then the uptrend has resumed. This is what happens as volatility has been relatively lower and as the S&P has been in a consistent uptrend. At some time that breaks, and what you would see there is when the S&P comes off as VIX starts to rotate higher. This is what we sort of saw there in mid-September as volatility was increasing. The VIX got above 20, above 25 for the first time in a number of months. At this point, again, we have the VIX at the lowest level that it's been. I think what I take away from this chart are two things. Number one, a reminder that just because the VIX is very low relative to where it's been recently does not mean it can't go much lower from here. The second thing is to keep an eye on how we perform right now relative to some of these previous times when the VIX has been as low as it has. That could tell us a little bit or even a lot about what we could expect going forward. Next, we have the AAII survey. This is the American Association of Individual Investors. This is one of my favorite surveys to track only and mainly because of the deep data. I think a lot of times for me, looking at the markets using charts is basically doing a historical analysis of the markets. When you analyze charts, you're basically saying, here's what's happened during different historical periods, and what does that relate to what I'm seeing now? And a lot of the technical indicators and signals that we use are based on that historical data, what's worked before, and we apply those routines and that discipline consistently. What's interesting in the last 2 weeks is the AAII survey has spiked in a big way, rotated from a relatively bearish indication to a relatively bullish indication. It really goes back about 6 weeks. 6 weeks ago, the bullish sentiment got to one of the lowest levels we had seen in over a year when the VIX almost touched, the AAII bullish reading was just above 20%. It was about 25%. One of the lowest readings we'd seen since last summer of 2020. From there, over the next 6 weeks, the bullish indication has rallied or has increased in a big way. We have almost 50% bulls. And why that is an important number is when I've talked to sentiment specialists who focus on sentiment data in a consistent way, they have reminded me that the bullish reading above 50% is sort of a measure of euphoria. That's when you can describe the bullish sentiment as euphoric. Euphoric for me is not a bullish thing. Constructive is bullish. Mildly bullish sentiment is an encouraging sign. Euphorically bullish, excessively bullish is where you start to get concerned, because that tells you the anecdotal last buyer has made their trade. That tells you that everyone's all in. Who's left to push the market higher if everyone's all bulled up and has already bought their positions and is riding the price higher, right? The market goes higher because of additional capital that's able to be deployed into the markets, or additional demand, or decreasing supply, or some combination of all of the above. So this bullish reading getting above 46%, nearing 50%, which is what I would be looking for going into next week, puts it in a relatively small number of observations, which tends to be at the later stages of bull market phases when the market is excessively bullish. The last time we've been this high was back in April of 2021. Now, granted, the bullish sentiment has decreased pretty steadily since then, and the market has gone higher. But if you look back in history, the bullish sentiment being above 50% is actually not necessarily a great indication for the long term. The second thing is the differential between bulls and bears is at the highest level it's been for the last 4 months. The spread between the two is almost just about 19%, which is again a pretty broad spread between bulls and bears. We only have a second left, so I just wanted to hit very quickly. The name exposure index has indeed spiked higher. I was expecting this to happen given the strength that you've seen in stocks. This is a survey of money managers and how much they're allocating to equities, and you can be long or leveraged long and say you're 200% long equities. The fact that this has spiked from about 50%, 55% about 3 weeks ago to where we're at currently just below 100% is quite a rise in this positioning data. Above 100%, similar to the bullish sentiment being above 50%. This reading being above 100% tells you excessive bullish positioning, tells me to start to be concerned. So investors in a lot of ways in the last couple of weeks have gotten, for all intents and purposes, all bulled up. Let's continue and wrap this show with the 3 and 3, 3 charts, 3 minutes. Here we go. Chart number 1 is a $sign TNX. This is the 10-year Treasury yield. Craig Johnson, my guest today, was talking about energy stocks, and I don't disagree. My conversations with Greg Schnell at gregschnell.com have had a very similar bent, thinking about energy, thinking about natural gas, thinking about copper stocks, and the strength that you're seeing in some of those basic materials and energy names. So I get the argument. I would say one of the more constructive charts you can see is rates rising and what that means for the financial sector. The XLF relative to the XLK is what you're seeing at the bottom. When rates go higher, that tends to be a tailwind for financial stocks, a headwind for growthy stocks like technology. You can see how this ratio has been sloping higher over the next couple months. Rates going higher and particularly eclipsing 175 on the 10-year, I would say is a tailwind for this ratio going higher, which means in general, you want to be looking at opportunities within some of the banks and less in some of the growthy sectors. Again, big if that rate goes higher. Chart number 2, we talked in our segment on sentiment, focusing on the AAII Bull Bear survey, and you can see that almost 50% of respondents were bullish this week. That is one of the highest ratings we've had, and literally the highest rating we've had since late June of this year. Before that, in April and March, where you had a number of readings above the 50% level. That sort of excessive bullishness is usually characteristic of the later stage of a bull market. This has been an interesting year where the market's gone higher, even though the sentiment has come off. But now we're once again seeing investors very much buy into the bull market phase. Finally, our last chart today is CSX. It's one of the railroads, and railroad stocks are an interesting one to watch. My guest yesterday, Ms. Schneider, was talking about the transportation index, and I completely get the argument. When transports are doing well overall, that tells you economic conditions are pretty decent, because those are the stocks, the companies that are distributing goods around over. It's a good representation of the demand, right? How much are people looking for some of these goods to come their way? CSX broke to new highs this week, which is super encouraging. It's actually down today, doing what's called a shooting star pattern, which is not a bullish thing. That's when you have a gap higher, you have a open and close near the lower level, a high upper shadow that indicates that actually there's short-term distribution during the trading day. So long-term, you have the encouraging sign of CSX making new all-time highs. On the downside, you have a shooting star pattern suggesting some short-term weakness. So interesting chart to watch through the remainder of the week as the relative strength has broken out, as the stock has become overbought, and we have a negative candle pattern. Let's pay attention to this and see if it can hold that breakout level. Folks, that's our show for today. Special thank you to Craig Johnson from Piper Sandler joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.